Most people think owning some gold or silver means they're prepared for 2026. History shows that assumption is usually the mistake. There is a common belief that simply holding gold or silver automatically places someone on the safe side of what's coming. That just having exposure is enough. But history tells a very different story. In nearly every major monetary transition, many of the people who believed they were prepared found out, often painfully, that they weren't. Not because they chose the wrong assets, but because they held too little, structured their exposure poorly, or misunderstood what those assets were meant to do when real stress arrived. As we approach 2026, this distinction becomes critical. What lies ahead does not resemble a normal economic slowdown or a routine recession. It represents a structural shift involving debt, currencies, liquidity, and trust. In that kind of environment, vague exposure is not the same thing as real protection. Simply owning precious metals symbolically does very little if they are not held in a way that meaningfully offsets risk. This conversation matters now because preparation only works when it happens before pressure becomes obvious. By the time fear is widespread and instability is visible, prices have already adjusted and choices become reactive. The opportunity to position properly usually disappears just when people feel the most urgency. That is why the real question for 2026 is not whether gold and silver matter, but how much is actually enough to make a difference. There is a wide gap between owning precious metals in name and owning them functionally. That gap is where most people get caught. To understand what enough means, we first need to be clear about what gold and silver are designed to protect you from. They are not magic assets. They do not eliminate volatility or guarantee gains. Their role is far more specific. They protect purchasing power during monetary disruptions, policy errors, and confidence shocks. They are insurance, not growth engines. And insurance only works if it is sized correctly relative to the risk it is meant to offset. The risk environment heading into 2026 is very different from what most people are used to. This is not just about slowing growth or rising unemployment. The core issue is debt saturation combined with political pressure on monetary policy. Governments are carrying debt loads that cannot be sustained without inflation or financial repression. Central banks are increasingly trapped between defending currency value and supporting markets. When forced to choose, history shows they tend to protect markets first. That choice has consequences for savers. When real yields are suppressed and purchasing power erodes quietly, financial assets become dependent on policy support. In that environment, tangible monetary assets play a different role. Gold acts as a hedge against the loss of currency credibility. Silver occupies a more complex position, tied both to monetary stress and industrial demand. This dual nature is why silver behaves differently than gold during transitions, and why holding one without understanding the role of the other often creates imbalance. One of the biggest mistakes people make is thinking in percentages without context. They hear simple rules like 5% in gold or 10% in precious metals and assume those numbers apply to everyone. They don't. Allocation is not about copying a model portfolio. It's about matching exposure to risk. Someone with high debt, limited savings, and income fully tied to the financial system faces very different risks than someone with low leverage, diversified income, and strong cash flow. Enough is relative, but it is not arbitrary. Time horizon is another critical factor. Gold and silver are not designed to protect against short-term volatility. They protect across cycles. People who panic and sell metals during temporary drawdowns often bought them for the wrong reasons. Protection assets feel uncomfortable when owned correctly. They are not supposed to make you feel rich during asset bubbles. Their purpose is to prevent financial ruin when those bubbles deflate. As we move toward 2026, multiple structural pressures are converging. Government refinancing needs are accelerating. Interest costs consume larger portions of public budgets. Political cycles increase pressure on central banks to prioritize growth and employment over currency stability. At the same time, global confidence in reserve currencies is being tested by sanctions, trade fragmentation, and geopolitical realignment. These are not theoretical risks. They are already visible in policy decisions and market behavior. Central banks themselves are signaling this shift through actions rather than words. Despite higher prices, they continue accumulating gold. Not because they expect immediate collapse, but because they are reducing counterparty risk. When institutions that issue currency choose to hold an asset that cannot be printed, it tells you something about how they view the future. Individuals should pay attention to that signal. Silver adds another layer to this picture. Unlike gold, silver is consumed. It is essential to energy infrastructure, electronics, medical technologies, and defense systems. As industrial demand grows and supply remains constrained, silver's dual role creates both volatility and opportunity. But volatility cuts both ways, which is why sizing matters even more for silver than for gold. So how do you think about Enough, in practical terms. You start by defining what you are trying to protect. If your goal is preserving purchasing power through inflation and currency weakness, gold tends to do that more consistently. If your goal includes potential upside from monetary stress combined with industrial scarcity, silver plays a larger role, but neither should dominate your financial life to the point where liquidity or stability is compromised. Liquidity itself is often overlooked. Physical metals are not as immediately liquid as cash or equities, especially during periods of stress. That is part of their strength and part of their limitation. You never want to be forced to sell protection assets to cover short-term needs. Metals should sit on top of an emergency buffer, not replace it. People who skip this step often end up liquidating metals at the worst possible time. Sequence also matters. Inflation rarely moves in a straight line. Policy responses lag. Markets swing between complacency and panic. Gold and silver tend to respond at different stages. Gold often leads during confidence shocks. Silver often accelerates later, when liquidity expands and inflation becomes visible. Understanding this sequence helps prevent emotional decision-making driven by short-term price moves. There is also a psychological dimension. Holding precious metals requires conviction. There will be long periods where they appear to do nothing, while other assets outperform. That is the cost of insurance. People who cannot tolerate the discomfort often abandon their position right before it becomes valuable. This is why enough is not just a number. It is an amount you can hold without constantly second-guessing yourself. For some people, enough may mean holding metals sufficient to cover a year of basic expenses if purchasing power declines sharply. For others, it may mean protecting a portion of long-term savings from financial repression. There is no single answer, but there is a wrong one, and that is assuming minimal exposure will somehow scale when stress arrives. It won't. Another common mistake is anchoring to nominal prices instead of real outcomes. People ask whether gold or silver is expensive without asking what those prices represent relative to debt levels, money supply, and purchasing power. In an environment where currency creation outpaces real output, nominal prices lose meaning. What matters is what an asset can buy over time. As 2026 approaches, the margin for error narrows. Adjusting early is easier than adjusting under pressure. That does not mean making extreme moves. It means being intentional rather than reactive. The people who navigate transitions best are not those who predict perfectly, but those who position conservatively and remain flexible. Combining gold and silver thoughtfully matters. Gold provides stability and credibility. Silver provides optionality and leverage to monetary stress. Used together, they can balance each other. Used poorly, they amplify mistakes. The goal is not to maximize returns, but to minimize regret. Historically, meaningful protection has often come from allocating roughly 10 to 25% of net worth to precious metals, depending on individual circumstances. Below that range, metals tend to feel comforting but financially irrelevant. Above it, volatility and liquidity constraints increase. Within that allocation, gold typically acts as the anchor, while silver provides measured exposure to upside potential. Ownership structure also matters. Physical metals remove counterparty risk but introduce storage and liquidity considerations. Paper instruments offer convenience but rely on system stability. A layered approach can provide balance, as long as each portion has a clear function. As we move toward 2026, the issue is not whether the financial system will continue to function, but how it will function and who it will favor. Systems under stress tend to benefit debtors and institutions closest to policy decisions. Savers usually bear the cost. Gold and silver provide a way to partially step outside that dynamic, but only if held in sufficient quantity to matter. Ultimately, enough is the amount that allows you to remain flexible, solvent, and calm across multiple scenarios. It is not about predicting disaster. It is about acknowledging uncertainty and limits to debt, limits to policy, and limits to trust. As those limits become more visible, the role of tangible monetary assets becomes clearer. The window to prepare rationally is always before urgency takes over. That window is still open, but it does not remain open forever. Preparing while conditions are relatively calm is far easier than scrambling when they are not. The goal is not alarmism, but realism. And realism begins with understanding that owning precious metals is only the first step. Owning enough for the right reasons is what actually makes the difference.